Hi, I'm Shawn Hyde, a business appraiser with over 25 years of experience in our industry. And today I want to talk about benefit streams. Now, in business appraisal, the basic formula for determining value is income divided by risk equals value. And that's pretty easy, except those variables can be tricky. So as far as income goes, there's several different benefit streams we can look at. We could use gross revenues, we could use gross margin, we could use reported pre-tax net profit, we could use something called seller's discretionary earnings or net cash flow, calculated either to invested capital or to equity. But every different benefit stream is a different number. And the modifier or the denominator of the formula, the risk rate, also needs to match the selected income stream. One of my favorite examples to talk about is comparing value to a 2x4, a length of board, just a piece of wood. We can take a tape measure and we can measure that piece of board. Say it's 36 inches. That's easy, we can look at it and see it. In business appraisal, it's kind of like that, where the value is going to be what the value is. But it shouldn't really matter what method is used to measure it. I could measure that 36-inch board using miles. I could use centimeters. I could use millimeters. I could use fathoms. The length of the board's not going to change just because the measuring system that we're using is different. So for that, keeping that in mind, I have run into different appraisals where the appraiser used an income stream, say EBITDA, earnings before interest, taxes, depreciation, and amortization, but applied a risk rate that's designed to be used with net cash flow. That's going to come up with the wrong number. It's kind of like looking at, in the market approach, if you have various multiples, you can see tracked against SDE, seller discretionary earnings, or EBITDA, but applying one of those to gross revenues, you're going to get a wrong number again. So when you select a benefit stream for use valuation, make sure that the income is measured with the appropriate risk rate. Otherwise, you're going to get some screwball answers. And math is funny that way, because if you punch in different variables, you'll get an answer. Whether that answer makes sense or not, though, is the question. If you'd like to discuss some of those options or questions with us, give us a call. We'd be happy to talk about them.